Okay, so let me explain more in detail now. What is mean by payback period? Yeah? Okay, payback period means when you invest. Okay, when you invest, what will be the what will be the what? What will be the period? Period means what? How many years? Okay, how many years or how many months you will be getting back your capital that you invest. Okay, because that is the most important rather than be thinking about the what? Profit. Okay, profit is always the second part that we have to think. When a owner or boss do investment in anything, they always the first part of call is what? They will think when I will get back my capital. Is it I will be getting back my capital or not? Loss is not a problem. Loss means you're not supposed to lose your capital. Loss means you lost your business. When you open up a business, you lost your business, no problem. But you have to get back your capital before the business is what? Go lost. Okay? I'm talking about loss in what? In the business, not loss in a capital. So you guys as a finance managers, maybe one day, okay, you always must think how to get back the capital. You always must think when you're going to get back your investment. Okay, you should not lose your investment. You should get back. Once you get back, then in the second part, you think the profit definitely. Okay, but of course, when we do budgets, yes, we do budgets. Okay, when we do budgets, we show when we'll be getting back the profit and all that. But you also must explain in how many months or years we are going to get back the capital. But example, if you invest in a business and then you're getting back your capital maybe next 6 years, is it a good business? I don't think so. What next 6 years? Then after that, after the 6 years, then you're gonna get profit. Your boss is already old and died and already went into the grave, right? Okay, so who gonna enjoy the profit? Nobody gonna enjoy the profit. So in current situation, guys, maybe that theory applicable what 20 years back. You wait for 6 years, then you get profit. That is what 20, 30 years back story. But now you want to wait for 6 years, you already went into the grave. Okay, so we can't do that. So you as a finance manager, you always must think what is the fastest way to get back the capital in investment. Okay. Now we have to change the theory. Yes, the theory says in how many years you get back the capital. But we have to think how fast we can get back the capital. If the formula says 3 years, you cannot follow the formula. Formula says 3 years, but you have to think how to make it what? More faster or more shorter. Always do that. Okay, that's your job, guys. Don't forget. Now, how about accounting rate of return? Any idea? Accounting rate of return? There is a word of return, right? Okay, there's already got a word of return. So, what does it mean for? Accounting rate of return. It will give you the percentage. What percentage is that? Return. How many percent you will get from the investment that you did? Am I right? Okay, how many percent? So that is called ARR. But we have a problem with ARR. There is also a disadvantage in ARR. What is that? There is a problem with these two techniques. These two techniques, yes, it's a very easy technique to calculate. Yes, of course, it will give you how many years, it will give you a percentage. But what is the disadvantage? We have learned this in the business class last time. What is the disadvantage? Any idea? These two techniques does not consider the what? Does not consider what, guys? Does not consider the time value of the money. You know what is time value of the money? For example, You buy, you know what happened, right? Currently what happens, okay? You go buy um, 1 ringgit roti canai 15 years back, okay? No need to say 15 years back, 1 year back. You go buy one roti canai, you already eat, okay? You have another balance of 1 ringgit. Then you take that 1 ringgit, you go to the bank, then you put it into the what? Fixed deposit, okay? Then end of the year, after 1 year, you get 1 ringgit and 20 cents, and then you come back to the same mama shop, and then you buy a roti canai. But now the roti canai price is 1 ringgit and 20 cents. Do you get it? Do you get what I mean? Okay. Now, what is the point here? Do you get the point? What is the point here? Time value of the money means the increase in the price of the goods and decrease in the value of the money. Okay? In other words. Because is it the same 1 ringgit will be the same after 1 year? Is it the same? No. Is it the same 1 ringgit will be the same value after 1 year? It will decrease, am I right? Those days 10 cents is a very big value, right? 10 cents you can buy one Suzuki. Yeah, seriously. My mother told me. My mother is 65 years old. Will be 70 68, going to 70. So she told, those days when she's small, in 10 cents she can buy one Suzuki in a day. Okay? 5 cents is nasi lemak. Very cheap. But now, 5 cents per value, 10 cents per value. So there is a decrease in the value, increase in the price. So guys, when you calculate this payback and accounting rate of return, it does not consider, it does not think the time value of the money. You don't know that the goods price going to increase and the money value going to decrease. It does not consider that part. But NPV, yes. Why? That's why we have the discount factor inside. That's why we have the inflation inside. That's why we have the tax factor inside. Okay, NPV has everything. Okay, so that it considers the time value of money. Okay, guys. So that's a disadvantage of these two formulas, basically. And what is internal rate of return? Anyone? Internal rate of return. Internal rate of return when the NPV is what? 0, in other words. Okay, it's something like a break-even point, right? Something like a break-even point. No profit, no loss. If NPV, you get a positive answer, that means we accept the project, right? If we get a negative answer, we reject the project. But internal rate of return, it will give you a percentage when NPV is equivalent to what? 0. That's the use of IRR. Okay, when you take that percentage, then you calculate NPV, you get NPV 0 exactly. Okay, and okay, we have something new which is you never learned before: annuities and perpetuities. Now, what is this annuities, guys? Annuities means every year is the same. That's why they call annuities. Annuities, later when we look at the example, you can see every year the value or the cash flow will be the same. It won't be different. For example, year 1 50, year 2 50, year 3 50, year 4 50. Every year is the same. Okay. Perpetuities. Ever heard about perpetuity? It's just a normal English word. Actually, perpetuity. What is perpetuity? But mostly you will use this word in the finance. Perpetuity. Any idea, guys? Perpetuity. Perpetuity means forever. What is another word for forever? Infinity. Remember? You know what is infinity? You have learned this in maths, right? Maths, they will use infinity, correct? In finance, they call perpetuity. Perpetuity and infinity is the same meaning. Okay? Forever, there's no end. Forever, you're going to get the same value or the same amount. But there is no end, no limitation. Okay? Annuity, same value, but maybe you have a limit, maybe 5 years or 6 years, for example. Okay, but perpetuity means forever. There's no end until you die. Until you die, maybe you continue to your what? Your children or whatever, forever. Okay. Now, so that's the use of all these techniques. So let's start with the exercise number 1. So we start with the payback period very fast, very quick one. So we're going to start with the payback first, payback period. So we have, if we look at the, what we call that, we have a project A, and then we have a project B, am I right? Okay, so we start with the A first. Now, be careful here. Can you see that in the year 5, we also have another year 5 called residual value. What is residual value? You have that in accounting, right? What is that? Scrap value. Let me ask for the question. Can we include scrap value in payback? Yes or no? Yes or no? No. You shouldn't include residual value in what? Payback. Okay? You include in what? You include in ARR. Okay? We include in what? NPV. Okay? ARR different calculation, NPV different calculation. We will see later how it works. Okay? But not in payback. Payback don't include, please. Okay, so let's start. Year net cash flow cumulative. So year 0, 1, 2, 3, 4, 5. So we're going to do it for A first, project A. So we have 90. Now what we have? We have 30, right? What is the net cash flow? 40, 30. Okay. 40, 30, 20, 20, 20. Correct? Okay, let us start. Still remember how to calculate payback? You start with the same value, here 90, correct? And remember, what is this, guys? This is your capital, remember. We need to calculate when we will get back the capital. The 90, when we will get back, in how many years or in how many months, for example. So what we do now here, we take the 90, we minus with what? 40. How much you get? You get 50. Negative or positive? Still negative, right? Still have a balance of what? 50. Then you minus again. How much you get? We have 20. Then you minus again. How much you get? 0. So how many years? 1, 2, 3. So what will be the payback period? 3 years. Now, same step, repeat for what? B now. Year, net cash flow, cumulative. For the B now, 0, 1, 2, 3, 4, 5. We have 20, 10, 8, 6, 4, 4. So repeat the same step again. Start with 20, then you minus, you get 10, am I right? So negative, then you get what? 2, then you get what? 4. But we got a problem. We need exactly when we get back the what? The 20. This is your capital. Okay? We need to calculate when we get back the 20, not the profit. The 4 is your profit. Extra. That's already profit. We don't want the profit. We want what is the year in the middle. How many years? We know that 1, 2. We know that the payback period is going to be 2 years, but how many months? So what we're going to do here is, guys, we take the last negative divided with what? Next year cash flow. Okay? So we divide. Take the last negative, divide with the next year cash flow. So that means 2 divided with 6 times with what? 12 months. How much you get? So you get 4 months, am I right? Correct? Yeah. So what will be the comment? Which project is better now? A or B? Definitely we go for B because that has the shortest payback period. Project B will be better option due to result in what? Shorter payback period compared to project A. Are we okay so far? Yeah. So this is how you calculate payback. Okay, we have done this in the business maths last time. Okay. Now let's move on to the next part. Now, the advantage and disadvantage, guys, you guys go through by yourself. That's a theory. Like just now I explained what is the advantage of payback and what is the disadvantage of payback. Look at that. They have mentioned that it does not consider time value of the money. Okay, this is the one I explained just now. Okay, but that's always the main factor. Time value. Okay, that's always the main factor. Okay, but I'm not saying payback is not important. It is important, but we cannot 100% decide based on what? Payback. Payback you just can calculate. You show to your boss, okay boss, these 2 projects will be getting back the capital how many years. That's it. That's only used for payback. Remember. Okay, but don't decide based on payback. Now next, ARR, accounting rate of return. So look at that. We have the formula ARR, annual profit, average annual profit divided with what? Average investment. Average, remember, we need the average. Okay, so we have working need to get it done. That's why you can see I already gave you the format over there. Okay, how to calculate the average profit and how to calculate the average investment. Okay, so let's start. Next will be the accounting rate of return, ARR. Formula average profit divided with average investment times 100. Now, let's do the working first for average profit. So we're going to do it together for the A and for the B as well. Both project together. Okay. So what the format says, guys, what we need to calculate first. What is the first step? You need to calculate what? Total cash flow. Okay. So first one, total up the what? Net cash flow. How much? Total net cash flow. How much? For the A and B. So we are still in the same exercise. Don't forget, we're still in the same exercise. So do you get 130? And then how much will be? Do you get 32? Okay. What is the next step? Less what? Less your depreciation. Now guys, can you tell me how do we calculate depreciation? We're going to calculate based on straight line or reducing. What information we have in that question? Do we have a straight line information or reducing information? Are you sure? What we have? Think carefully. We have a scrap value over there, am I right? When you have a scrap value, remember straight line method formula, SLM? What is the formula? Cost minus scrap value divided with useful life, right? Okay. Of course, accounting EUEL, right? I don't know what is that. Yeah. It's useful life. Now, but when you divide with the useful life, okay, you get it for 1 year or how many years? Why we divide with useful life? When you divide with useful life, you only get 1 year depreciation. But over here, we need to calculate for 1 year or 5 years. Remember, we need to calculate for 5 years depreciation. Okay, 5 years. Remember, 5 years depreciation. Because the project is for 5 years, we need to calculate 5 years. The question here is, do we need to divide with useful life? Do we need to divide with 5 years? No need. When we divide 5 years, you get it for 1 year. You want a time frame 5? Not necessarily. So So what we do? We take the cost minus what? Scrap value. That's going to be the formula. Cost minus what? Scrap value. So what is our cost? The cost is our capital. Okay, the cost is our capital. So over here, guys, 90 minus what? 4. And here is 20 minus 2, isn't it? Yeah. So how much you get? So you get 86, 18. Remember minus. So what do you get? So here you will get 44, 14. And this we call as what? Profit. Correct? Okay. This we call profit. Now, but guys, is it we are done? Profit? No, we need average profit. Okay. So you divide with what? Divide with years. Remember, divide with years. So you divide with how many years? 5 years. So then you will getting back your average profit. So 8.8, 2.8. We just done the average profit. Let's move on into next working average investment. Now, average investment. What is the first step, guys? Investment, right? Okay, what will be your investment? So, investment is 90, 20, am I right? For A and B. Okay, and next is what? You add what? You add your, you add your residual value, in other words, your scrap value, right? Okay. This is where I told you just now, we will use the residual value over here in your investment. Okay. Now, so how much is residual value? 4 and 2. So you get 94, 22. Next is what? You divide it with 2 to get the average. Okay. So divide. So you divide with 2, divide with 2, and what will be your average investment? And then we work out the ARR. We take 8.8 divided with 47 times 100. How much you get? Then we take 2.8 divided with 11 times 100. How much you get? You get 18.72%. So you get 25.45%. Yep, we're done. So guys, which project is better now? Based on ARR. Definitely high percentage, right? High ARR will be the better because the return is higher. Okay, so this shows that B has higher return, alright? So again, project B will be better option due to resulting higher ARR compared to what? Project A. Okay. So what's again? Okay. Next. So we are done with the payback, we are done with the ARR. Okay, so can you see that for the ARR also we have the advantage and disadvantage. But look at the disadvantage part. The first point, the gain, does not consider the what? Time value of the money, right? Always the main factor. Okay, so that's why we cannot 100% rely on these both formulas. We can calculate, yes, but we cannot make decision based on these two formulas. Always come back to what? NPV, end of the day. Okay, so you just go through that guys for yourself. It's just theory. Now let's very fast recall back how to calculate compound interest and simple interest. Okay, look at exercise number 4. So remember compound interest, simple interest, which is also in the business maths last time. Topic number 1, right? Interest computation. Now, okay, let's start. Exercise number 4. Calculate the total interest earned on $1,000 invested for 3 years at 10% per annum under the both simple and compound interest. So they want you to calculate the both simple interest and compound. They want what? Interest amount, yeah? Okay, interest. So let us calculate that. But a bit different here. Look at this. In finance, if you still remember, in business maths, how the compound interest formula look like? Remember? Example number 4. Remember how in a business maths compound interest formula? In business math will be V equals to what? P1 plus R power of T. But now a bit different, yeah? It's no more V. It's changed to what? F. Still the same, but just that F. F means future value. Okay? What will be the future value? Because yes, we are calculating for the future value, right? Okay? Next 10 years, what is going to be the interest? So, more applicable, F. Okay? Future. P means present value, today's value. So how much you borrow today, that will be the P. And how much you have to pay next 5 years, that will be the F. Am I right? In total. But remember, if you still remember, what is the F? F means what? Accumulated amount. Just recall back here. Accumulated amount, which is interest plus the what? Principal. It's together. It's already been total, in other words. Okay, accumulated amount means total. Total of what? Interest plus principal. So let us start with the simple first. Simple interest. So remember the formula, I equals to what? PRT. So they invested 1,000 times, what will be the rate? 10% in 3 years. So 10% times 3 years will be what? 300. Okay, 1,000 times 10% is 100, 100 times 3 is 300. So that will be the answer. So next will be compound interest, which is, that will be the formula, F equals to P1 plus R power of T. So $1,000 times with 1 plus what? 10% power of 3 years. So you will get 1331. Check it out. Now if you still remember, you will get 1.1, am I right? Okay, 1 plus 10% is 1.1. Then you power of 3, remember. Then you need times with what? 1,000. So 1.1 power of 3 get 1.331 something, right? So you times with 1,000, you get 1331. But is it the final answer? No, haven't. They just want the what? Interest, remember. Okay, so what you should do? To get I, you have to take F minus what? P, correct? So you take 1331 minus what? 1,000, you will get 331. That will be the interest value. Now if you still remember, which one will give you more interest? Compound interest. Here we are, you have that, you have the example, it shows that compound always will give you the high interest. Okay, that's why if you go to the bank, they won't calculate based on simple interest. If you take a loan, is it they will calculate using simple interest? No, right? They will calculate use what? Compound interest, because they want to charge you more. But if you want to take fixed deposit, what formula they will use? Is it they use compound? No, they will use what? Simple, because they want to give you less interest. Okay, so that's the difference. That's why we have these both formulas. So end of the day, who lose? Always we lose. Okay, always we lose. So that's the example number 4. Now, so guys, can you try example number 5? Again, the same thing. Very quick one. 5 and 6 and 7 by yourself. But exercise number 5 is that they're asking about interest or total. Look at that. Value. Am I right? Value means total. Calculate the value. 38,000 invested for 7 years at 5% per annum. So simple compound, right? Okay, remember. So F equals to P1 plus R power of C. So 38,000 1 plus 5%. 7 years. So you get 53469.82. Next, example 6. What should be invested now to receive 10,000 in 4 years time? 8% per annum. What this is, guys? They already gave you the F. You have to find what? P. Yes, reverse calculation in other words. So F equals to P 1 plus R power of T. Now you have to find the what? P. So it means what? F divided with what? 1 plus R power of T. So you reverse the formula. So 10,000 1 plus 8%, 4 years. How much again? You get 7350130, right? Correct? Then exercise 7, again the same thing. What is the present value of 115,000? 9 years times 6%. One plus 6%, power of 9 years. How much you get? So once again, that's about compound and simple, very fast recall. Okay, guys. Okay, guys, come. Let's continue into uh, NPV now. Net present value. So we're still going to use the same exercise for calculate the NPV. Okay, now if you look at it, the year part, what I did, I classed the residual value in. Okay, you don't need to put it separately because it's just wasting of time because it's in the same year, right? Okay, why you want to calculate separately? We can calculate together. So what I did is 20 plus 1, put it together. So this is where I told you just now in NPV we will include the scrap value. This is how you include in the cash flow. Okay, in the cash flow you include. Now, how I get the discount factor 10%? Because it is from the question. Look at that. Can you see that? You are also told that the cost of capital is 10% in the question, in the bottom of the question. You have that 10%. So that is your discount factor, 10%. Now, do you still remember how to calculate discount factor? What is the formula? What is the formula for calculate discount factor? Remember, 1 what over what? 1 plus r n, am I right? Okay, power of n. Example, if it is a year 1, example, yeah. The rent you calculate by yourself. Example, if it is a year 1, what do? 1 over 1 plus 10% power of year 1, am I right? If it is year 2, then you change to year 2. So, guys, come, let's calculate the discount factor now by yourself. So, the first one you should get 0.909. Then you should get 0.826, 0.751, 0.683, 0.621. Then what you do, you take the cash flow times the discount factor. So you plus all these, remember, then you minus with your what? With 90, so you will get 14.72. Is that correct? Check. So remember, this is for your project A. Remember the answer? 14.72. Okay, so let's work out the next one for B now. Year net cash flow, discount factor, still the same discount factor, 10%, then the present value 0, 1, 2, 3, 4, 5, 20, 10, 8, 6, 4, 6. 4 plus 2, the residual value 1. So just copy back the discount factor to the same one. Yep. 0.826, 0.751, 0.683, 0.621. So you get 20 over here, 9.29, 6.61, 4.51, 3.73, 3.73. Correct? You get 6.67. So again, the same thing, you plus then you minus. So now, which one has the highest NPV here? Let's do the comment now. A, right? 14.72. So that will be the better option. Project A. Project B. So let me ask one question. If I ask you, which project is better until this stage or until this level, which one to choose? We have done payback, we have done ARR, we have done NPV. Based on these three methods, which one you will follow? Definitely what? NPV, right? Because what? If in the exam, we want to explain more in detail why we choose NPV, because it considers the what? Time value of the money. Don't forget that point. Yeah? Always bring up the point in the exam, because that will give you more marks. Why we choose based on NPV? Because it considers time value of the money. Simple. Okay? And payback and ARR does not consider the time value of the money. So how about the others got the answer? Okay, now next. So next will be the IRR. So this is the IRR formula. And I have to still remember in IRR, guys, like what I told you just now, when we calculate IRR, it will give you a percentage. But that percentage when what? NPV is 0. It will give NPV 0. But remember, to get that percentage, we need a positive NPV. We also need a negative NPV. Okay? Yeah. We need a positive NPV, we need a negative NPV. So guys, in the exam, remember, we got a problem. In the exam, they only will give you one discount factor. Okay? One discount factor. So you will calculate, and then you calculate, you get an NPV positive. You need to find by yourself for the negative NPV. If you get a negative answer, you need to find by yourself a positive NPV. Okay? Remember we did in the business maths, trial and error. Okay, we estimate what will be the discount factor to get a negative answer or positive answer. Remember, don't worry, we will do it in a while. That will be exercise number 9. Okay, now that will be exercise number 9. We will do it now. So, what is it in exercise number 9? But how you design? Look at that. I put a note over there. How we design. If the IRR is greater than the cost of capital, in the discount factor, okay, accept the project. That's how we decide based on IRR. If the company discount factor is 10%, for example, and then if you're getting a IRR 11%, then we accept the project. If you less than the company discount factor, you get 9%, then we reject the project. Why? Because I told you what IRR is what when NPV is what 0, and you are getting lesser than the company discount factor. For example, you get 9%. 9% is 0. That means your target is 10%, and 9% now only you're getting 0, correct? Okay, so you're not achieved the target, correct? Okay, the target was 10%, so you must be above what 10%. Okay, then you're above the target, correct? Now look at that, exercise number 9. For the project A, calculate the NPV at 20% discount rate, then use these to estimate the IRR. If the company cost of capital is now, look at that, company cost of capital is now 15%. So they told that now the discount factor of the company is 15%. Cost of capital is 15%. Should investment A be undertaken? But we have to calculate the NPV based on what percentage? 20%. Okay, for project A. So just now we already calculate 10%. Now we're going to calculate for 20%. Okay, so let's work out that now for exercise number 9. So here, net cash flow, discount factor 20%, present value 0, 1, 2, 3, 4, 5, 90, 40, 30, 20, 20, 24, correct? So 1, 0.833, 0.694, 0.579, 0.482, 0.402. So do you get negative answer 4.99? Check. Then we're going to calculate the IRR. So remember guys, NPVA means not project A, yeah? Don't get it wrong, okay? Always students will get it wrong on that part. They always get confused, okay? Because sometimes the example of a exam question also they use the name of the company as A and B. So they think that project A and B. No, this is only for project A. NPVA means positive. NPV means what? Negative NPV. This is low discount factor, high discount factor. So please, the exam don't get confused here. So now, what is our low discount factor? We already calculated just now, right? Which is a 10%. Yes, 10% plus NPVA, which is the previous example. How much we get? 14.72, correct? 14.72 plus 4.99 times 20 minus 10. Now, why do I put plus over there? The formula is minus, right? Why do I put plus? Minus minus positive, correct? 4.99 is negative, formula is minus, so minus minus become positive. That's why I put it plus over there. And guys, one more thing, 20% minus 10%, do we need to press percentage? Do we need to press percentage? No. Why was that? Because in your discount factor just now when you calculate, do you press percentage? No. We already changed it into what? Decimal. It is actually, if you look at it here guys, 0.833 is actually a percentage. It actually is what? 83.3%. Yeah. This is actually 83.3%, 69.4%. But we change it into decimal. So over here also, when you calculate IR, you don't press any percentage. But it is a percentage. So do you get 17.47%? Correct? Yeah. Definitely. Don't forget we have to comment end of the day. Now, what they say, what is the company cost of capital? 15%, right? So we get IRR is what? 17.47%. Higher than the company cost of capital. So we accept or reject? Accept the project A, yes. So the company should accept the project A due to result in higher than the what? Company cost of capital. Okay? Just do it in your own words here. Okay? Accept or reject. Shouldn't be a problem. Next. B. What the B says now? The NPV of project B at 20% is what? 1696. Estimate the IRR and decide whether B should be undertaken. Cost of capital is 15%. So still the cost of capital is 15%, right? Okay, does not change. So they say NPV of project B at 20%. See, look at this. 20% is 1696, right? Still what? Still what? Still what? Positive, am I right? Okay, that's a point here. Still positive. We need to find what? Negative. The question here is, guys, should we use higher discount factor or lower discount factor? There's not 10% positive, 20% positive. But the value is increasing or decreasing when we use a higher discount factor. Decrease, right? Okay, decrease. Just now we get 6 point something, correct? Now it's 1.6, so it's decreasing. Remember, to get a negative answer, you should go what? Higher discount factor. Remember, Okay, to get a negative answer, you should go higher discount factor. To get a positive answer, you should go lower discount factor. Remember this, put a note here. To get a negative answer, you must choose a higher discount factor, 20% or 30%, for example. If you want to get a positive answer, you should go lower, 10%, 5%, 2%, or something like that. You have to go lower. But depends on the question. You look at the value. So now here guys, 1696. 1696. Nearest to 0 or far from 0? Far from 0, are you sure? Look at the question carefully. 1696. Nearest to 0 or far from 0? What is that? Think carefully. Let me tell you, it is nearest to 0. Very near. What was that? Guys, remember, they gave you in 1000, but do we use 1000 just now in the question? No. We never use 1000. Yes, the question was 1000. Look at the question back. You saw that at the top of the question, triple zeros, but they already cut down the zeros and put it in the bracket. But they tried to confuse you by giving 1696. But can we use 1696? No, we can't. We should use what? 1.696. Remember, divided with 1000. Okay, there's a small trap here. Don't fall in the trap, but you just fall. Okay, so 1.696. Now let me ask again the question: nearest to 0 or far from 0 now? Very near, right? Okay, very near. Now, so next we have to work out for the project B now. Part B now. Again, year, net cash flow, discount factor. Now, discount factor, how many percent we should use? Since it's very near, can we use 25%? Yeah, should be enough here, 25%. Don't go so high. No use also. Okay, 25% should be okay. Present value. So 0, 1, 2, 3, 4, 5, 20, 10, 8, 6, 4, 6, 1. Sorry. $0.20 negative, right? Check. Then we calculate the IRR. %, plus 1.696 divided 1.696 plus 0.2 times 25% minus 20%. So how much we get? Is that correct? Or getting different? Correct, huh? So 24.47%. What will be the comment again? Yep. The company what? Should accept project B due to IRR as result in higher than the what? Company cost of capital. Okay. So guys, now we got a problem here. If the company want to choose the boat project, should be okay. But not all the time, all the companies will do all the projects, right? They only will choose one project. Now we got a problem which is project A also we accept, project B also we accept, correct? Which project is better now? A or B? Final conclusion. Which project is better now? A or will be the B? But definitely we have to forget about the payback and ARR, forget about it. We don't take that into the consideration. We only take NPV into the consideration. But we got a problem. We accept the A, also we accept B. Look at the part C now. That's what I say. If A and B are mutually exclusive, which project should be undertaken? What is mutually exclusive? Mutually exclusive means you only choose one project. You only can choose one project. That's called mutually exclusive. You only can choose one project. So in that situation, which project you choose? Your part C. Which project? Any idea, guys? But the point is there. The point is there in the A and B. When we do the part A and B, the point is there. You have to do something with the A and B. Again, with the NPV. What is that? They told you on your part A and they told you in your part B, the cost of capital of the company is 15%, correct? Never change, correct? Part A also 15%, part B also 15%. And then the C, they ask which project you guys have to choose, the company. So what we do now? Do we choose based on IRR? No. Because end of the day we come back to NPV, right? Okay. So if you want to choose based on NPV, what you should do? We have to recalculate back based on what? 15%. Okay, that will be the better choice. Why? Because the company cost of capital is now is what? 15%. So it's a better idea if we choose So now, so that will be the better choice. Okay, but they never tell you, the, they never tell you the question, but in the exam also you have to understand, you have to go through the question carefully. It looked very simple to see, right? They ask you to choose, but actually you have to do a major calculation over there, which is for the A and B, we have to do it for 15%. Let's do it together. Don't waste some time. Do it separately. Do it together. One shot. So here, net cash flow. This is going to be for the A. Discount factor going to be what? 15%. And what will be the present value, correct? Okay. And then again, net cash flow. This is going to be for the B. And what will be the present value? One shot. Okay. So 0, 1, 2, 3, 4, 5, 90, 40, 30, 20, 20, 24, 1. Here going to be 20, 10, 8, 6, 4, 6. Okay. So what will be the NPV for the project? So in the exam also, you don't waste your time, guys. You do for A1 and you do for the B1, because what? Both discount factor going to be the same, right? So you can do it together. Okay? Unless the discount factor is different, then you do it separately. Yep, we are done. So you get 4.01 for A and 3.97 for the B. Check. Almost similar, right? If you round it up to 4, the B, right? 3.97, you round it up to 4. But the small differences, finally we can make our conclusion that what? A is better option. Okay guys, so at a discount factor of 15%, which is the company cost of capital. So we calculate based on the company cost of capital, then we decide kind of which one will be the better option. Now you only do this if in the exam they ask for just one project. If they never ask, then you don't need to do this part. Next, let's go into annuities now. Okay, so now how annuities works. Look at that. Exercise number 10. A project costing 2,200 as a return expected to be £1,000 each year for 3 years and a discount rate is 10%. Required A. Calculate the NPV using existing analysis. Existing means what we calculate just now, the normal way. Okay, can we do it very fast? Just 3 years way, alright? Okay, this is the normal way. So what we're going to do it here now is exercise number 10, part A, the normal NPV way, which is year, net cash flow, discount factor 10%, present value, correct? 0, 1, 2, 3. 2,200, 1,000. So over here it's 2,200, 1,000, 1,000, 1,000. 1, 0.909, 0.826. .751. So over here is 2,200, 909, 826, 751. So you get 286. Correct? Now this is the normal way if you want to calculate. But guys, you don't need to waste your time by calculating this way if you have same cash flow every year. You can use shortcut. That will be the B. Okay, your B, we're going to use the annuities, which is a shortcut by the way. Okay, year, net cash flow, discount factor 10%, present value 0, 1, 2, 3. Shortcut, because every year is going to be the same. 2,200, 1,000, 1. Now what we're going to do here is we're going to use a formula to find out what will be the discount factor for 3 years. Okay, so the formula is going to be, this is going to be the formula here for the annuity. 1 minus 1 plus r power of negative n over r. That will be the formula. So therefore 1 minus 1 plus 10% power of negative 3 years, negative 3 year, power of negative 3 divided with 10%. How much you get? So do you get 2.487? So over here it's 2.487. So you get 2,200 over here. Then you get 2,487. So therefore you get 287. Check. Correct? So it's still the same answer, right? It's just a bit different, the decimal. Uh, if you total up this, you will get 2.486 check. Am I right? If you total up that, that's why you're getting 286 over there. Right? Not mistaken. Check again. Yeah? 2.486, right? Yeah. Why are we getting 2.486 over there? Because when we calculate one by one, we are rounding up. Right? Over here, we straight away use the formula to get the total. That's why you get 2.2487. But which way is better? Of course, second way, right? Shortcut, right? Okay. But you have to know the formula to calculate the discount factor. That is the annuity formula. That is how you calculate the annuity. Annuity means every year is the same, so we can use the shortcut. Can we use this formula when you have a different net cash flow? No, you can't. Yeah. Remember that. Don't go use this here. Now, C. So guys, C, they want you to calculate IRR, but we can calculate very fast, am I right? Okay, since every year is the same, and we're getting a positive answer for 10%, am I right? Okay, can we go for 25%? Or can we go for 20%? Do we will get negative answer at that? Definitely, right? You try and see. We don't know. You try and see. Year, net cash flow, discount factor 20%, present value. Because we have a positive answer, now we want to try for what? Negative answer for the IRR. So 0, 1, 2, 3, 2,200, 1,000, 1. So we're going to use the formula again. R, which is 1 minus 1 plus 20%, power of -3 over what? 20%. So you will get 2.106. 2.106, you get 2.106. So you get 94. So you get negative 94. So let's work out the IRR now. A NPVA minus NPV times B minus A. %. NPVA will be 287. Positive answer. 287 plus 94 times 10%. 20% minus 10%. So how much you get? So do you get 70.53%? Check. That would be the IRR answer. Correct? Yeah. Okay, so far so good. So that will be the how to calculate the annuities. But this only can get it done if the cash flow every year is the same, yeah. Remember that. Don't go use it when we have a different cash flow. Now, next we have the exercise 11. What is it? Exercise 11 says, calculate the present value of an annuity of £1,000 per annum for 5 years starting. So they just ask you to calculate present value. Okay. A, 1 year from now. So how do you calculate, guys? Anyone can tell me? Year, net cash flow. Discount factor was, how much is that? 10%. And then they want the present value. Okay. Now we got a problem. They said 1 year from now. 1 year from now, which should be 1 year from now should be what? 1, 2? Come again? How you put the year? I know that this is going to be 1000 definitely. But when you identify the year, then you need to calculate the discount factor, right? So what will be the year for part A? 1 year from now, project is 5 years. So 1 year from now should be 1, 2, 3, 4, 5. So it should be what? 1, 2, 5. So how much will be the discount factor? Do you get 3.791? So here will be 3791, correct? So that will be the answer. So that will be for the A. How about for B now? Year, net cash flow, discount factor 10%, present value. Now what the B says, in 4 years time. So guys, in 4 years time, what will be the year? Any idea? How many years first? 4 years time. What will be the year? 0 to 4 in 4 years time. Anyone? 0 to 4 is it? 0 to 4. Wrong answer. Wrong answer. Is it 0 to 5? No. Wrong answer as well. What will be the answer? Come again? 1 to 4? No. Remember how many years the project? 5 years. They said in 4 years time. It should be n in which year? In 4 years time means starting year what? You're starting in year 4. That means what? 4, 5, 6, 7, 8. 5 years. Again, it should be 5 years, but in 4 years time means you're starting from year 4. 4, 5, 6, 7, 8. 5 years. So it should be what? 4 to 8. Okay, you must understand the question very carefully here. Okay. Must come back to 5 years. Yeah. 5 years project. But they're starting on year 4. So when they start on year 4, end up in what? Year 8. 5 years. But question here is, guys, what is the discount factor? What is the discount factor? Anyone got the discount factor? Is it just a, seriously I'm telling, it's a primary school math. The concept is a primary school math. Yeah. Of course, formulas you use the formula, but the concept to calculate 4 to 8 is a primary school math. Okay, no problem. Let me show you the working of the discount factor now, over here. Now, let us put it in timeline so that it's easy for you to understand. 1, 2, 3, 4, 5, 6, 7, 8, for example. Okay? Now, what happens here? Our project is 4 to 8, right? We need to find this answer. This is a question mark here, all with the discount factor. Okay? It is in the middle of what? 1 to 8. Actual was 1 to 8, right? Okay, actual was 1 to 8, remember. But we are calculating from 4 to 8 because we're studying in 4, year 4. But what you should do first? You need to calculate what first? Yes, you have to calculate the total first, 1 to 8. Okay? And then, what you should do? What you should do? You minus the what? You minus this 1 to 3. Am I right? What was it? It's a primary school math, right? You calculate 1 to 8 first, get the value. You minus 1 to 3, you get the balance, right? Am I right? Primary school math, right? I'm not joking this now. Seriously, right? We need to find the balance, so we take the total minus the 1 to 3, then we get a 4 to 8. Okay? So guys, can you calculate 1 to 8 first? How much the discount factor? So you get 5.335, correct? Then you calculate 1 to 3, how much? So you get 2.487. But remember, you have to minus this, correct? Minus this, and you will get the balance of what? 428. So you get 2848. So it comes over here, 2848. So the answer will be 248. Are you okay? So that will be the B. C. Immediately. Immediately. Now. Right now. Immediately. That means right now. How you calculate? How you calculate, guys? Immediately, right now. Today you start from year 1 or year 0? Today you start. You start from 0, right? Today you start. Immediately you start, you always year 0. Okay? But remember, we need to fulfill the question of what? 5 years. So the next should be what? 1 to 4. Very good. 1 to 4. Another 1000. Okay? But end of the day, come back to what? 5, right? 0, 1, 2, 3, 4, 5 years. Are we okay? So come back to 5 years. So over here is 1, so here is 1000. And we need to calculate 1 to 4 now. So you get 4170 total. Remember, year 0 is not negative here. Okay? I never said negative year 0. We are starting from year 0, so it's still a positive value. They never say that's an investment. So don't put it as negative. So what's it, guys? Okay? So we just have one more part, one more last exercise, exercise number 12. Then we are done with topic 6. Okay, now, what is this exercise 12 about? So annuity is done here. Understand about annuity? Yeah? So you must make sure that you understand the question very carefully. Yeah? You starting from which year, you end in which year, but you must fulfill the what? 5 years. Remember. Okay? Next, perpetuity. So, like what I told you in the beginning of the topic, perpetuity means forever, infinity. There's no end. In other words. Okay? Look at the formula for perpetuity. Annual cash flow divide with what? interest rate. Are we okay? Annual cash flow divided by interest rate. Now, look at exercise number 12. A company expects to receive 1,000 each year in perpetuity. The current discount rate is 8%. What is the present value of the perpetuity? Okay, let us calculate. So, now guys, but there is actually, this is the old notes, but based on new notes, you have to calculate two formulas over here. The first one is the perpetuity. Use the perpetuity formula to calculate. So that means what? Annual cash flow divide with what? The discount factor, right? Okay. So over here, what we have? 1,000 divided with 8%. So you get 12,500. Very simple. Now, this is if the formula. Let me ask the B now. If I want to calculate using NPV, how do you calculate? I know discount factor is 8%. Question is, how many years? If I said use NPV, how many years? Any idea? Infinite. But we need to have a year to calculate NPV. We cannot have an infinite. That's why we have the formula. But sometimes in the exam, you need to use the NPV. Right? If you have a situation where infinite, but you have to use NPV, what will be the year? What will be the year? How long a human can be alive? Seriously, I'm not joking. How long a human can be alive? According to science. Maximum? According to science, 100, right? Okay. Can we go for 100? Yeah, that's the answer. 1 to 100. Normally we calculate according to science, 1 to 100. So, what you will get? 12.494. That will give you 12.494. Is that nearest to that? Am I right? Okay. The balance 6 is what? What is the balance 6? Balance is 6, right? Compared to this. Okay. Compared to this, you have a balance of 6, correct? Now, what is the balance of 6? That's the infinity. Okay, that's the infinity. Will go into the what? If you're alive after 100 years, maybe 101, you will get the next 6. Okay, yeah. After the what? 100 years. That will be the infinity. Yeah. So guys, are we okay so far today? Understand? So this is a basic, and the next class we will go into the advanced part.